Everybody, all right, let's get going. It's 3:30 on a Monday. Has anybody had anything going on in their world over the last week since we've got through the Liberation Day on April 2nd? Well, it's certainly not been without a lot of craziness over the last few days. And so it's just been one of those times when we see volatility spark up, and it's good just to have a conversation about what we see going on and all of that. So we've got a lot of folks in here with us today. Will's logged in as well. That's the blank screen that you're seeing to monitor the chat and the Q&A. So if you have any questions along the way, I please hope that you'll enter those and let us know what you're thinking about. A few of you sent your questions in, and I appreciate that. So what I plan to do is just give a few comments about what's happened so far, what we think it might mean, talk a little bit about the landscape as it stands today, like kind of where do we go from here and what could and what we think may and may not happen. As you know, I don't do forecasts, so it's really just an idea of what opinions I've gathered. Spent a lot of time on this, spent a lot of reading and watching webinars and listening to podcasts and trying to sort through all of the noise to really understand what's going on. So whether you want to call it tariff tantrum, tariff gate, tariff Armageddon, I kind of made this one up. It's like tariff Armageddon, but it doesn't roll off the tongue very well. So anyway, over the last week, tariffs were laid out on 59 countries, excuse me, at about a 10% minimum. Some of them are even higher than from there. Many countries were excluded, like Canada and Mexico and Russia, interestingly. And some sectors were also excluded, like semiconductors. So that creates its own set of problems because a lot of these goods and things that are made in multiple countries and are covered across multiple sectors. So it's not really clear what's going on as far as like a semiconductor that's made in one spot, but then is used in a component in a car that's manufactured somewhere, how that's going to work. These are the highest tariff rates that we've seen from the United States since the early 1900s, 1910. So really a restructuring of the global trade market over 1 week. And whenever you see that kind of change, whenever you see that kind of policy issue change that's going to affect so many parts of the economy, you are going to have massive volatility. And sure enough, that's exactly what happened on that following day. So what it's done is create uncertainty about everything: inflation, recession, employment, consumption by the consumer, the dollar. And, it sounds like, too, it's important that we get our due from some islands whose only occupants are penguins, from what I understand. So I'm not trying to be lighthearted about any of this. I'm just trying to bring some levity to a relatively insane situation. I've been involved in a lot of bear markets in my career. I've seen a lot of violent moves in the market for a variety of reasons, most recently being COVID. When COVID struck, we had a pretty clear understanding of why it was happening. We knew that with a global economic shutdown, you were going to have recessions, you're going to have, a massive amount of consumption coming off of the table. All the things that promote growth in economies was basically gone. Out of our control, a disease that came and caused a lot of that disruption. This, however, appears to be completely self-inflicted. That the way this policy was rolled out, I think, was severely flawed. And I'm not making any political observations. I stay independent in that lane. But just as a rational person that deals with markets and deals with investments, I just have seen so many other ways I feel like this could have been handled. It doesn't do any good to be mad. I was allowed to be mad on Friday. Lisa says I'm not allowed to stay mad. So now what we have to do is figure out how to move on, how to deal with, some of the way this has happened. So the other thing that I'm also trying to be very conscious about with this is that it's a massive chance for us to make behavioral mistakes in this kind of environment. And the reason I say that is because you're mixing two things that don't mix well, and that is money and politics. And so we can allow our politics to make bad decisions about our money. And so it's one of those times when we have to keep a level head. We have to see the forest for the trees as best we can and understand that overreacting in the short term rarely serves us well, no matter what's going on. And I don't think that's any different in this situation. So Trump's shown that he's not concerned about the short term, but it remains to see if he even has an understanding of what's going to need to happen here in the long term. I understand his motivation. I've read about it. I understand where he wants to go with this. It's the process of getting there that just seems incredibly disorganized and very difficult to decipher. And so I've got a quote here I want to share with you from a commentator, Shea Ballure, and this is how he summarized it. This wasn't rolled out as a part of a comprehensive American renewal strategy. It wasn't good Lord. It was not coordinated with the Fed. It wasn't communicated clearly to Treasury. It wasn't backed by a labor reskilling program or any form of public-private manufacturing incentive beyond empty slogans. It was dropped like a bomb, seemingly designed more to shock than to build. And in the absence of credible structure, capital is retreating, not realigning. That's why I think you've seen so much craziness in the market, is because what the markets crave more than anything is certainty. You rarely have it. But the more the uncertainty is levied, the more ups and downs you're going to have, and the more violent those moves could be. So when this rolled out, it just became very unclear as to what the end game was and how do we get there. So if the end game is to reduce tariffs that are coming into us, at what level will that happen? And it appears to be varied from nation to nation, to situation, and the big concerns, of course, are what's going to happen with China and the EU and how those are going to be resolved. These smaller countries in Asia and some of those kind of things are basically fodder to say this is getting worked out with this country and this and that. But the big issues are with those larger countries, and it's just difficult to see what concessions are going to need to be made to satisfy the administration that that's a good outcome and that there's been some sort of win. And as we know, that's in many cases what the psychological makeup of the president seems to be very important to him to win. And so the other thing is how this affects overall geopolitics. And for a while now, you've heard me talking about kind of a new world order and Ray Dalio's research in this area, where we go through these big geopolitical and these big economic cycles. And everyone that believes in that believes that we're near the end of one as far as our debt goes, our federal debt. And so it seems that there's some belief that this could be a shock and awe that will somehow manage to increase revenue so that we can pay down our debt. And what it really appears to be is just a complete realignment of how we're going to handle global trade and bringing more of our reliance on ourselves in our countries, which is going to result in other countries doing the same. And deglobalization has been going on for a while anyway, nowhere near to the extent that it's being, put in front of us right now. But it has been a trend that's been going on for a while after COVID, where countries didn't want to be as dependent on each other's energy, semiconductors, and medicine. And so they're beginning to bring those supply chains more on base. There is a case to be made that having access to goods from a certain country, or if we needed something and we couldn't get it because there was a trade war going on, is a long-term concern. However, how that transition goes and takes place is still highly uncertain. And once again, why you're seeing so much volatility in the markets is how does this all shake out? So George Friedman had a column out called The Geopolitics of Tariffs. And he said, the world order that has been in place through the 20th century has eroded, and a new era is being engineered. We're in a period in which the norms of the past century are no longer relevant. It is an infrequent and unsettling time. But throughout human history, this has been a normal abnormality. That gave me a little comfort to say, all right, we're going through a cycle, and this is just another move in that chain of events. And so, all right, that's what's happened. You're able to see that all over the news and everywhere that you look. Very unsettling and has created a lot of volatility in the markets. Today alone, the Dow was down 1,700 points at one point and up 800. That's a 7% swing in one day to both directions. Early in the day, there was a rumor that Trump was going to put a 90-day pause on the tariffs. When that didn't happen, it gave back, and now it's sorting itself through. At the end of today, we saw big tech start to reemerge a little bit. I don't know what's behind all that. When things are moving that violently, when you saw the percentage and the big changes like you saw on Thursday, Friday, and today, in my opinion, it is impossible to try to make big changes in the midst of that kind of environment. You can work around the edges if you want to when it comes to managing your investments, but when things are moving like that, it is not a time to make big changes in your portfolio. And I'm not one of those. I know I stress frequently that we need to stay the course. Unless life has changed, we need to stay the course and stick with it. In this short period of time, I still feel that same way. I've been through bear markets before. They're never the same. They always stink. And we all have to keep a cool head to say, where might this end up? Because if this policy was able to be changed this quickly and cause this much animosity in the near term, that tells me the opposite could also be true. That if there was a remedy, or if there was some more clarity from this, or if the Fed was to lower interest rates, whatever kind of good news came out of Washington, we could see this reverse very quickly. And for those that would think maybe I should be getting out right now in the hopes that I can get back in at a certain time, this, in my opinion, is not one of those times to do that because things are moving so incredibly quickly. All right, I'm going to share a couple slides with you. All right, so we know a little bit about what's going on year to date. You can see the S&P down. This is through yesterday or through Friday, excuse me. S&P down 13, Nasdaq is down 19. The Magnificent Seven, made up of Meta and Tesla, all of those down about 24%. The EFA is the international stock market, and as you can see, that's up a little bit throughout the beginning of the year here. And then gold remains up for the year at about 15.5%. So big disparity in these returns. If I pulled up the dividend-paying stocks, I should have done that. They're relatively flat for the year. So you've had parts of the market that haven't been as impacted as others. All right. Let me move. I want to go to this one, which is a 1-year slide. So as bad as this has felt, if we go back to the same date last year to now, as you can see in many cases of the market, particularly gold, we're still up. And even on the S&P, we're only down 1%. So while in this near term, it's just felt like a very protracted, painful correction, over the last year, we're relatively flat. So what this tells me is essentially we borrowed this year's return last year. We were able to get the growth, the multiples expanded without a lot of earnings going up. And when you do that, you're essentially borrowing from the future. And now we've given all of that back. So that gives us a chance, in theory, if market cycles were to be persistent, to reset and to grow back from here. Where that goes in the midst of all of this is very, very difficult to say. But I feel like it's helpful to see this, to see that over this period of time, we've done okay. And then if I go back and look at and show a 3-year chart to you, you can see all of these indexes are up pretty significantly. If we expand our time horizons a little bit, it's easier to make better decisions in times like now when things are that choppy. Because if your money's still supposed to be working for you 3 years from now, I'm not saying this is what it could look like, but historically, this is not an unusual chart to see where the markets have done okay during that period of time. The other thing I wanted to show you was consumer confidence right now is at a low, and that was before this happened. And so through the end of March, consumer confidence on this right-hand side in the low green is low. And you can see whenever you've had a trough in sentiment where consumers are not feeling good about buying, they're worried about their job, they're not moving, they're not buying new appliances. When all of that's going on, over time, the next 12 months in the market has historically been pretty good. And as you can see, that is a time that we're at right now. You throw in what's happened over the weekend, and I would imagine this is even higher, where people are not looking to make changes. If they were thinking about buying a new house, maybe they're pulling back, larger purchases, all of that with that recession fear that's weighing on everything. With this trade policy change, that would even make this lower. But after these sentiment troughs, we've tended to have pretty good returns in the market. And the last thing I wanted to remind you of is that corrections in the market are not unusual. In fact, they're highly common. We didn't really have one last year. We had a little bit of a pullback around 8%, but corrections as they're defined are at least usually 10 to 15%. And so you can see in all these years, the red dots on this chart represent how far the market went down during that calendar year. And you can see some of these are violent, 28, 49%. And not always does the market go up from there. The '02 mix is in here. We certainly had COVID as part of this, as well as the '08 banking crisis. But in common years where we have 16, 19, 10% corrections, we can still have a decent year in the market. It doesn't preclude that it has to go down from there. A couple other things I would say to this. Historically, when the market has been down 15%, 83% of the time, you've had a successful return in the next year. If the market's down 20%, you've had an 87% success rate going forward. And if it's been down 25%, you've had a 93% chance that the market will be up over the next 12 months. And that average return is right around 12%. I'm not telling you that's what I think is going to happen because I don't know. And anyone that does tell you that they know right now is feeding you a line because it is moving way too quickly and there's way too many end games. Let's explore a couple of those. One could be that Trump backs off in the short term. There doesn't appear to be, based on the weekend shows that I saw, any plans for that. So what could happen there instead is maybe some residual agreements begin to get made where we'll back off if you back off. The payback tariffs from other nations begin to slow down. Countries come to the table, deals are negotiated, on we go from there. That would be a positive outcome there at some point because there'd be more clarity. The fact that the market ripped up today 800 points in the midst of a rumor that there's going to be a 90-day pause tells you how the market would react if something like that happened. Very clearly, they would be looking to make the market would be looking to absorb that and move on and go up from there. So some sort of just resolution of any sort is going to be welcomed by the market. The second would be is if the Fed was to lower interest rates. Based on what Chair Powell said on Friday, I don't see that as a likely outcome. They're going to want data, and it's going to take a while for that data to filter in. That's going to be like higher unemployment, higher inflation, all of those kind of things is what they're worried about. Their mandate is to keep unemployment low and to keep inflation low. Until they have the data support that that's being changed, they're not going to step in and make a rate adjustment, I don't think, even though they're getting pressured by Trump to do so. That would be another positive outcome. A negative one could be that this continues and it gets worse. We get escalated trade, tariffs and issues, and it really grinds the global economy to a halt. We were already beginning to slow as far as GDP goes and growth in our country goes moving into this period of time. And so the chance that it moves into a recession makes it even easier for that to happen. One thing I want to remind you about recessions, we usually don't know that we're in them until they're over. The market will price them in early on, and they will reemerge. The market will reemerge long before the recession is over. It's going to be looking for 6 to 9 months into the future. So if we're in a recession now and are heading one for this summer, the market will begin to recover, expecting that things will get better the first part of next year. So while we're having some spring volatility that may even morph into the summer a little bit, you wouldn't be surprised to see, even if it's short-lived recession and some of this does get resolved later this year, that we could have a resurgence in the market once again that would be very difficult to predict and to know exactly when to get involved there. So it's one of those times when you want to stay invested, you want to rebalance. If there's an opportunity to do that, that's what we do on your behalf here at PrairieFire. And then always be ready for if there's an opportunity set that sets up that just becomes so obvious that something's been grossly oversold that we can take advantage of. But a lot of our planning and portfolio building and risk metrics go in before these things happen. So we want to be ready for these for a range of outcomes. Global trade war wasn't a range of outcome that we've been thinking about, nor was COVID, nor was the Greek debt crisis. There's been 100 things I could list off for you that we weren't exactly prepared for, or we didn't think was going to be the reason the market would go down, but nonetheless, here we are. Thank you for those of you that sent in questions. One I got was if in the past, it's always been a good idea to ride these things out. However, in this situation, when you've got basically uncertain policy anchors behind the scenes, is it still the right idea? And I think until those actually get remedied, that yes, it is. So it's clear what the policy plans are, but the way that this administration moves on a dime makes it much tougher to say we're in such uncertain territory that we should definitely abandon our plans and make big changes. There could come a time when you'll hear me say that I think we should. I don't think in a 3 to 4 day market upset, even though this has been dramatic and how it's going to affect the global economy, is one that we'd want to move on a dime or again make big changes. Working around the edges, things like that could change that view. And I think we need to give it a little bit of time. I know that stinks and that's not fun to do when the markets are moving around this quick, but we kind of have to see how this filters in. We are a very adaptable people and we're a very adaptable economy. And when a door is closed, a lot of times new ones open. And companies will adapt to these kind of things, even if they're a little bit uncertain. What they're not going to be doing is making big future plans right now. They'd be nuts to do that. However, if they're like, all right, it's going to be more difficult for me to get goods from China, what do I need to do? That's what the American capitalistic system does best. Adjust to the situation once they understand it. Right now, it's not understood. And so that's why you're seeing these ups and downs. There's also a question about the outlook for Q2, 3, and 4. It's obviously very reasonable to expect things are going to flatten or go down slightly in our GDP outlooks. We are hosting a call, and I wanted to make sure everybody will know this. You'll see this in our follow-up email. But I'm interviewing Mary Ann Bartels next Tuesday at 11 o'clock Central. Marianne is our chief market strategist at Sanctuary that handles all of my back office team, and I get a lot of their investment research and intellectual capital. It's a real honor to have her. She's got a very clear viewpoint on these markets. Her outlook today was very sanguine, like mine is. It's just impossible to say where the things go from here. However, we were on firm footing coming into this. Yes, earnings were slowing. We weren't, robust by any stretch, but people that wanted a job can pretty much find one. The consumer was relatively stable. The banking structure remains sound. But all of this threw the whole thing up in turmoil, and it's going to change everybody's outlook. I'm noticing everybody bringing down their S&P 500 forecast for the year, to the mid 5,500, something like that, where they were into the sixes for a lot of firms up until this point. So it's going to cause some readjustment for sure. But even if growth flattens a little bit from here, we can always reemerge from this once again if we have some clarity. All right, Will, do we have any questions?
None that I am seeing.
All right, I'm not showing any open questions. If you have one, throw it in the Q&A if you'd like. Happy to answer any more specific questions. We'll be staying in touch on this. You'll be seeing a lot of our commentary and stuff coming out in our emails, etc. If you know someone that would like to hear this and missed it, we will save the recording and put it on our YouTube channel so they can see that. But I would encourage everybody, let's let cooler heads prevail a little bit and see where this takes us. I don't think by any means I'm telling everybody just to sit on your hands and do nothing. We need to stay informed. And when it comes to your investments, once again, if we're moving from 1,700 down to 800 up in one day, I don't know how you successfully trade that. No one I've ever met does. Our idea then would be if there's a chance to rebalance our bond portfolios a little bit, if there's a chance to take advantage of some of these stocks that have sold off. The Magnificent Seven being down 23% is no surprise to me. They were overvalued. The prices got really high. They were running at revenue expectation numbers that are just very difficult to meet. And so we didn't know what would be the reason they would correct, but here we are. And so they're definitely highly impacted by China, more so Apple in particular, I'm thinking of. And so that disruption is causing their current angst. Tesla, I don't need to tell you what's going on with Tesla. So the rest of the market, like I said, dividend payers are holding their own. We've always had a value tilt over the last 18 months, and those value stocks, the buy low, sell high, have held their own, with healthcare being one of the best performing sectors. I'm really surprised by, I guess I shouldn't be, but I've been surprised by the banks and the financials' poor performance these last few days through this. Usually they can be a bit of a stalwart in the midst of this, especially if they're paying dividends. But I think there's just a lot of concern about, where lending goes from here, and if a bank does international business, how that's going to be impacted, all that. So you bring that uncertainty into the picture, and they're going to have some ups and downs. We will be staying at our post here at PrairieFire, keeping abreast of what's going on, doing the best that we can to inform and help all of you as we get through this. And we sure appreciate your support and being here today. I'm sure we'll be talking to everybody real soon.